Hello everyone, and welcome back to my channel. In today's video, we will discuss one of the most exciting and intriguing topics, stock market investing. So whether you're a beginner looking to dip your toes in the water or an experienced investor seeking to take your portfolio to the next level, this video is for you. So could you sit back, relax, and let's dive in. 1. Stock market basics. To start investing in the stock market, it is essential to understand its fundamental working. The stock market is a platform where buyers and sellers gather to trade shares of publicly traded companies. When an individual buys a stock, they own a small percentage of that company. As the company performs well, the value of the stock increases, and the investor makes a profit. However, the stock market is highly unpredictable and volatile. The market can be affected by factors such as global events, company news, and economic indicators. Therefore, it is crucial to research and analyze the factors that may impact stock prices before investing. Staying informed and making informed decisions are essential to successful investing. Investing in the stock market can be profitable, but it requires patience, discipline, and a willingness to learn from mistakes. By understanding the basics and conducting thorough research, investors can make informed decisions to help them achieve their investment goals. 2. Tips for beginners. If you're new to the stock market, feeling overwhelmed is understandable. But with some knowledge and some common sense, you can begin building a successful investment portfolio. To get started, it's crucial to do your research before investing in a company. This includes analyzing the company's financials, management team, and competition. Next, look for patterns and trends in the company's stock price, and try to understand the factors driving those trends. Another important tip is to start small. It's not wise to jump into the stock market with all your savings at once. Instead, start with a few $100s and gradually build up your portfolio as you gain more experience and confidence. Diversification is also crucial. It's essential not to put all your eggs in one basket. Instead, spread your investments across a variety of stocks and sectors. This helps to minimize your risk and protect your assets from market volatility. Lastly, it's essential to have a long-term perspective. While the stock market can be unpredictable in the short term, it tends to provide solid returns over time. So avoid getting too caught up in day-to-day fluctuations and instead focus on the big picture and think about the long-term potential of your investments. By following these tips, you can build a successful investment portfolio and become more comfortable with the world of stock market investing. Remember to stay patient and disciplined, and continue to learn and grow your knowledge in this exciting and dynamic field. 3. Strategies for experienced investors. If you're an experienced investor in the stock market, you may be looking for advanced strategies to take your portfolio to the next level. Professional investors often use a few methods to maximize their returns. Value investing. Value investing involves looking for stocks undervalued by the market based on factors like the company's financials, management team, and growth potential. The idea is to find hidden gems the market hasn't fully recognized yet and buy them at a discount. This strategy requires patience and a willingness to wait for the market to catch up to the stock's value. Growth investing. Growth investing involves investing in companies that are expected to proliferate. These companies may not be profitable yet, but they have a lot of potential for future growth, which can translate into significant returns for investors. This strategy requires a long-term perspective and a willingness to tolerate volatility in the short term. Dividend investing. Dividend investing involves investing in companies that pay regular payouts to shareholders from the company's profits. These dividends can provide a steady income stream for investors and be particularly attractive for retirees or others looking for stable income from their investments. However, this strategy requires focusing on companies with a history of reliable dividend payments and a willingness to hold onto the stock for the long term. Technical analysis. Technical analysis involves looking at a stock's price chart and identifying patterns and trends that can help predict future price movements. This strategy is based on the idea that past price movements can provide clues about future price movements. Technical analysts use various tools and techniques to analyze price charts, including moving averages, trend lines, and chart patterns. Fundamental analysis. Fundamental analysis involves examining a company's financials and other qualitative factors to determine its intrinsic value. This strategy is based on the idea that a company's actual value is reflected in its financials and other fundamentals rather than just its stock price. For example, Fundamental analysts look at revenue, earnings, cash flow, and management quality to determine whether a company is undervalued or overvalued. Sector rotation. Sector rotation involves shifting your investments between different sectors of the economy based on which sectors you believe will perform best in the future. This strategy is based on the idea that other sectors tend to perform differently at different points in the economic cycle. For example, cyclical sectors like technology and consumer discretionary tend to outperform defensive sectors like utilities and healthcare when the economy is in a growth phase. Experienced investors use many different strategies to maximize their returns in the stock market. Each method has strengths and weaknesses, and no single approach suits everyone. As an investor, it's essential to research, understand your risk tolerance, and choose a strategy that aligns with your goals and values. 4. Common mistakes to avoid. Investing in the stock market can be a challenging and unpredictable endeavor. No matter how experienced you are as an investor, there are always pitfalls to watch out for. By avoiding common mistakes, you can increase your chances of success and protect your investments. One of the investor's most common mistakes is trying to time the market. This means buying and selling stocks based on short-term price fluctuations, which is challenging. Trying to time the market can lead to considerable losses if you get it wrong, and it can be tempting to make rash decisions when prices fluctuate. Instead, focus on a long-term investment strategy and avoid making hasty decisions based on short-term market movements. Another mistake to avoid is overreacting to the news. News headlines can be sensational and scary, but keeping a level head and not overreacting to every piece of information is essential. Remember, the stock market tends to be forward-looking and may have already priced in the impact of the news. So, instead of reacting to every news story, focus on the underlying fundamentals of the companies you invest in and the long-term potential of your investments. Diversification is another crucial factor in avoiding common investment mistakes. Failing to diversify your investments can leave you vulnerable to big losses if one sector or company performs poorly. Instead, spread your investments across various stocks and sectors to minimize risk and protect your assets from market volatility. Finally, chasing hot stocks is a mistake that many investors make. It's easy to get caught up in the hype around a particular stock, especially if it's been performing well lately. But remember, past performance is no guarantee of future results, and chasing hot stocks can be a recipe for disaster. Instead, focus on the fundamentals of the companies you invest in, and don't let short-term price movements sway your investment decisions. No matter how experienced you are as an investor, there are always pitfalls to watch out for. However, avoiding common mistakes like trying to time the market, overreacting to news, failing to diversify, and chasing hot stocks can increase your chances of success and protect your investments over the long term. So take a deep breath, stay calm, and stick to your investment strategy. You can achieve your investment goals and build wealth over time with a bit of patience and discipline. 5. Final thoughts. In conclusion, stock market investing can be exciting and challenging, but following the tips and strategies we've discussed in this video can increase your chances of success. Whether you're a beginner or an experienced investor, remember that there's always more to learn and that the key to success in the stock market is patience, discipline, and a long-term perspective. So take your time, research, and stay informed about the companies and sectors you're investing in. And most importantly, don't get too caught up in short-term fluctuations. Keep your eye on the big picture, and remember that investing in the stock market is a long-term game. Thank you for watching, and we hope you found this video helpful. If you have any questions or comments, please leave them below. And as always, don't forget to like, comment, and subscribe for great content on investing finance. Happy investing!